Hello, everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today, I don't think that you will need to see another Velocity Banking video. I think you're going to go ahead and it's all going to come together, perhaps on this video, perhaps not, right? But I wanted to break it down how we're able to pay off these 6-year, 7-year, 8-year auto loans, 30-year, 40-year mortgages, way less than what the bank wants us to. Remember, we actually paid off $30,000, $40,000 in like 15 months, 20 months instead of the 6, 7, 8 years that the bank wants us to. We want to make sure that you know about that, how to eliminate that in months, not years. And we also have a special edition today. We want to go ahead and break down a little bit of what is inside of Velocity Banking and why it works. But before we do that, like, share, and subscribe so that everyone around the world can know the power of Velocity Banking. As is our custom, we're going to start off by letting you know what we have here on my left and right side. Of course, we have real life, right? We've got loans, whether they're personal loans, whether they're auto loans. In this case, it is an auto loan that is a real auto loan. $37,000 at 15%. Why? Why not, right? If you don't have the credit score, if you're, in their eyes, lower, right, than others, then we're going to go ahead and charge you as much as we want, at least according to our scale, right? $880 each and every month. That's okay. We're going to go ahead and make sure that that's taken care of very quickly. Not in the 6 years that they want you to pay this off, or the 5 years they want you to pay that off, okay? The line of credit, yes, you do. You have one at $10,000 at 21%, $600 each and every month, all right? Now, we're going to use our line of credit differently than we have before. We're going to make sure that we're using our line of credit as leverage versus using it as other consumers use it. Does that make sense? Before we get into that, I want to show you the difference between traditional banking, what we were taught, and velocity banking. This is how we were taught. We were taught to make sure that you have, when you get paid the $5,000, make sure that that money goes to the bills, right? And so let's segment your income. We were taught segregation of income was a good idea. You're going to find out it's not. $1,200 towards, let's say, groceries, right? We've got $1,200. Of course, we've got the mortgage. And then $1,400, of course, we've got to save, right? And then the $600 each and every month goes to our credit card. And then another $600 goes towards our auto loan. Now, of course, we're not using this auto loan. It's going to be something that is the national average. And so we've segregated all of our money, which leaves us how much cash flow at the end of the month? 0 in cash flow, okay? And so that's how you were taught. You're going to pay the minimum monthly payments, whether it's the auto loan, whether it's our credit cards, whatever it is, mortgage, okay? You fill in the blank. You have 0 cash flow at the end of the month, and you're struggling. You're going to be taking years, okay, to pay off the loans that you got. But you don't have to do it like that. You know what you could do? You could look within the savings and you could say, well, wait a minute. Am I really saving? The value of my money is actually losing the more I keep the money in there. Could I use this $1,400 each and every month to actually pay off my loans and actually get a higher return because of the cash flow I'll be receiving from those loans? It's just from paying off those loans, remember that cash flow that was going out now has the opportunity to come in and you can actually do something with it versus locking that $1,400 up each and every month. Now, I'm not saying that that's not a good idea, because whether or not it's a good idea, is up to you. But this is what I am saying, that if you're saving for emergencies, make no mistake, that auto loan, right, that cash flow sucking loan is an emergency. And you've got to eliminate that as fast as you can. Because just in case, man, what if you can't pay it 1 month? Maybe 2 months, maybe 3 months. What's going to happen? All right? We want to make sure that that's paid off, and we want to make sure it's paid off wisely. If instead of segregating, and if instead of saving, what if we said, you know what? We need this cash flow right here to do more than it's been doing, which is just sitting collecting dust. Let's go ahead and add that to our cash flow. Let's no longer be accumulation minded only, but let's add that to our cash flow so that we can pay down our auto loan and our credit card. And oh, by the way, let's go ahead and make sure that we're using our line of credit instead of segregating all of this money. Let's use our line of credit as our new checking account so that instead of the credit card, us paying the $600 each and every month, we don't have to worry about another minimum monthly payment. Why? Because we're using our credit card as our line of credit. And as the $5,000 goes into our credit card, see, this is one big credit card now, okay? Goes into our credit card or our line of credit, we can then calculate the expenses, but don't forget to calculate that you are no longer responsible for the $600 each and every month because you've already paid your credit card with $5,000 each month. That deserves a marker drop, okay? Now, don't get me wrong. Of course, you're still responsible for the payment. But when the credit card company sees that you actually already paid the $5,000, you know what they count that as? A payment, even though we know it as a transfer. And then, of course, you're going to pay from the credit card. And yes, you can pay from the credit card. There are services that can help you in making sure that those things that can't be paid with the credit card are paid with the credit card, all right? You can then cross this out because now that's a part of your cash flow, okay? So now you have the $2,000 each and every month to do what with? To pay off that loan with. Now you see where that $2,000 comes from. We want to make sure that we're using this leverage, this cash flow for our advantage and not the bank's. And you're going to see exactly what I'm talking about as we take care of this auto loan. Watch this. Now I know you got some questions. You're like, yeah, but CJ, I know you can pay the auto loan and the mortgage with your credit card now with that third-party service, but what if the transaction fees? What about the transaction fees, right? Let's bring that up. We're not afraid to address that, and we're going to address that with the numbers, all right? So stick with me, all right? $37,000 at 15%, $880 each and every month. This is how it's being divided on month one. We have $462 in interest. That means you don't see that money. That's right. The $880 does not go to the principal. Somebody's got to get paid, and it's not you. It's the bank, at least for now. All right. And then $418 is going towards the principal. So really, this is wild. Okay. So you're only paying this down by $418. That's why it's taking so long. That's why they drag it out to 5 years. Okay. Because the $418 is going towards the principal instead of that $880. Now, if we were to use our line of credit wisely, we have the $10,000 at 21%. Remember, we're using it wisely now, so we no longer owe that minimum monthly payment of $600 each and every month. Now we're using it as our new checking account. We have, what, 5 months, right, until we pay that off, because $5,000 is coming in, $3,000 is going out, which leaves us what in cash flow? What's paying it down? The $2,000. And so this is what that calculation looks like, okay? This is how you can tell how long you're going to be out of any line of credit, okay? Any line of credit. $10,000 is the balance. We have $2,000 as the cash flow. All right, now if your cash flow is a little higher, if your cash flow is a little lower, go ahead and adjust this number, okay? We're gonna go ahead and label it. That way you have it for your ledger, okay? Line balance divided by cash flow will equal your velocity term. In this case, we're just gonna cross these zeros out here. 10 divided by 2. It's gonna take us approximately 5 months to get out of that line of credit. Once we have replenished our line of credit with the $10,000, where does that $10,000 go? That's right, it goes towards that $37,000. So let's just leave it at the $37,000. We're not gonna calculate the $880 multiplied by 5, right? Well, we're gonna leave it at the $37,000 because velocity banking is just that powerful. We can actually we can over-round, which means this number is actually going to be like 36 something, 35 something, but we're leaving it at 37 so that you could see the power of velocity banking. So now, 37 minus 27, because we are deploying our $10,000 towards that loan balance. You gotta make sure you say balance, okay? The loan principal, okay? Because the principal is the host and the interest is the parasite. The smaller the host, the smaller the parasite, okay? And so now we're at $27,000, which will let us know where our $880 each and every month is going now. Now that we've done that and reduced the principal to $27,000, we have skipped to month 21, okay? And now our payment of $880 is being divided up like this. $344 to interest, $536 to principal. Do you see how more is going towards the principal now and less is going to interest? That's how we pay things off. This right here. Remember, as you get rid, and you know what? You didn't have to do a second job. You didn't have to get a second job. You didn't have to starve yourself on the beans and rice and dirt diet, right? You simply had to move the money a different way. Does that make sense? So as you continue to do this, right, you're going to continue to pay the $880 each and every month. That is figured into the budget. So you're paying that, but guess what? You're also building up this line of credit, okay? So as your line of credit gets built up by the cash flow, what happens when it's the full $10,000? Well, you just do it again and again and again until you're done. Now let's go ahead and see what it's like under velocity banking. And we're also going to see what this looks like under traditional banking. And then you're going to make the decision whether it's okay to have those little fees that are attached to that third-party service so that you use that credit card or not. Let's go ahead and see that. All right, folks, so let's go ahead and let's see about the fees, okay? Let's see about the fees. It's about, what, 3% each transaction, but remember, you're not going to be going the full 60 months. You're doing velocity banking. That's the whole point of this. So as we do velocity banking, I want to see if it's worth it to you. Remember, the interest with velocity banking on this loan, okay, this auto loan is $2,371, and you're going to be out of that in a year and 1 month, right? So 13 months versus traditional banking, which is TB. I thought TB was a disease. and come to find out it is, right? Traditional banking, $15,813 in interest. That's $15,813 that's not going towards you, but going towards the bank. And of course, they want you in the full 5 years, 60 months. Some lenders even charge a prepayment penalty on some of the loans that they do. But on the 60-month, we want to just make sure that we are making decisions not because of a story, not because anyone persuaded us, but the numbers persuade us. So what is your take? Would you rather have the $2,371, right? And plus those fees, right? The transaction fees, which is 3%, right? Each transaction. Would it equal even half of this $15,813? What if the fees, right, the whole time was actually $10,000? What if? And it's not. But what if the fees were $10,000? Did you know that it would still be less than what you're doing under TB? So I just encourage you to make sure that you're making those decisions by the numbers. Get out of TB. TB is a disease. We don't want that. We want you to make sure that your debts are eliminated so that $880 can go to you instead of them. If you have any questions, of course, we've got a webinar coming up that addresses a lot of the questions that you may have. We need a system, folks. You can't do this by yourself. We have a webinar this Tuesday, about 5 p.m. Pacific time. Every Tuesday, we have a webinar addressing the problems, getting rid of the problems, all right? We want to see you on there. God bless you, and you take care. We'll see you in another video.